The types of people who engage in the stock market. The stock market is one of the greatest ways to earn for everyone, as long as you know how it works. A stock market is a place wherein you can buy a specific stock offered by a company. The goal in entering the stock market is to earn profits by buying at a low price and expecting the price to go up, giving you profits by selling at that price point. It can be simply described as buy low, sell high. In the stock market, there are two types of people: traders and investors. They may seem the same, but they have notable differences. Traders are for the short term, and investors go for the long term. However, it doesn't stop there. So, what are the qualities of a trader and an investor? What fits best for you? In this video, we will share with you the types of people who engage in the stock market. Before we begin, don't forget to subscribe to Money in Mind, a fun and friendly channel that will bring you high-quality financial advice towards happiness and success. Now, let's hop right in. Short-term versus long-term. Short-term periods are for traders. Traders take and set short-term goals. They expect to have short-term gains in a day, an hour, or even minutes. It is like knowing when to start baking a cake and getting it out of the oven to have a perfectly baked cake. So when they do it for a short period, they can do it many times in a day. On the other hand, long-term periods are for investors. Investors take and set long-term goals. They expect to have long-term gains in weeks, months, years, or even centuries worth of time. They take much more time in holding a stock compared to traders. They expect the appreciation of the investment in the not-so-near future. They also receive dividends from the company. Dividends are profits given to stockholders by the company. It is one of the perks which traders will probably miss. Sometimes, investors buy stocks to hold them for a very long time without the plan to even sell them. The active versus inert. Have you ever seen a sporty or a busy person? Notice how they practice and spend time doing sports daily. This priority makes them very busy all day. Just like a sporty person, traders are very busy in the stock market. Their activity levels are just high. Just as mentioned, they should know how to perfectly bake a cake. They should know when to open and place the cake inside and remove the cake from the oven. It is knowing your entry point and exit point. In trading terms, these are the buy signal and sell signal. Analyzing your buy and sell signals are also known as technical analysis. If a trader is an active person, an investor is an idle person. An idle is also known to be as lazy or static. They don't do much. They do not waste so much time doing technical analysis on stocks. What they do is just add more stocks to their portfolio. They don't engage much in the stock market compared to traders. Lastly, the two types of a safe player. The reason why traders do technical analysis is to properly identify their risk. That is why we will identify traders as the first type of safe player. They know that there is always risk in the trades that they will be taking. That is why they always try to balance the risk versus reward ratio before making a trade. Trades with risk are backed by safe havens. Traders put on a stop loss or exit point to reduce the sudden losses they will take. There are also things called price targets or limits that help guide them on where they should sell and take profits. In trading platforms, sometimes there are systems like this where it automatically sells when it hits the stop loss or price targets. It helps the traders have profits and fewer losses without the need in monitoring it from time to time. Investors are no stranger to playing it safe. Investors are also safe players, but differently. Investors are more inclined to know where they will be investing their money. They buy stocks or shares of a company based on its performance, like revenues, sales, projects, and many more. They don't plan on exiting or selling the share at a specific price point. Their motto is making the best decision and buying point in the first place so that they would not worry during the waiting game. Fluctuations and drastic price movements, even when it is a downward trend, are nothing and harmless. They take it as part of the stock's life. They are not worried since they expect it to be back or be higher in the future. In conclusion, a trader knows when to get in and get out of the stock, depending on their technical analysis or price movement. A trader does multiply trades daily and doesn't care about the background of the company. An investor goes for the long term, doesn't plan on getting out of the stock anytime sooner, plays the waiting game, and studies the company to make sure they are buying a good stock. Do you know what type of person are you in the stock market? It doesn't matter if you are an investor or a trader. What matters most is what works for you best and gives you the best profits. And there you have it, types of people who engage in the stock market. What can you say about this video? Comment your thoughts down below, give us a thumbs up, and subscribe to Money in Mind if you haven't yet. Stay tuned as we've got more content on financial advice coming very soon. Take care, and we'll see you in the next video.